Hi everyone, welcome back to my channel. If this is your first time into this channel, my name is Alvan, and I just want to share some insights that I got from Warren's recent annual letter. Okay, so let me go right into it. There are 5 points that I would like to share with you. So let me do my screen share over here. Okay, so this is Berkshire's performance ever since 1965 and until now, which is 2010, which is last year. And of course, you can see from here, last year they actually outperformed the S&P 500. Then over the last 50 over years, right, they have always double outperformed in terms of compound interest based on annualized return. And I would suggest to you, if you are really wanting to learn investing and really understand how the world clicks around the world based on different events, right? I think it will be good for you to look at all the past annual letter by him and together with his vice president, which is Charlie Munger. And I feel that every time their annual letter is being released, right, that comprises a lot of wisdom and knowledge that we can actually look into. Okay, so I'm going to share the first point over here in a sense. Is what he wrote here, that every time when it comes to owning companies or him buying any companies, right, he actually look at a few things, right? He look at really the durability or basically their long-term business performance. Okay, but when they look at long-term performance of a company, right, they are not looking as just to time the market. Okay, and it's clearly stated over here. So these are constant principle that he reminds the audience that they themselves, Charlie and himself, are not stock pickers, right? They are not here to pick stocks, but they are here to pick businesses, right? And they even give you some insights about what kind of business they actually want. So it is actually both durable advantages and a first-class CEO. Okay, so this is point number one. When you're investing in companies today, right, are you just looking at the price and all the ratios that comprises in terms of your analysis, right? Nothing wrong with that. That is called quantitative, right? But we need to also include qualitative in the sense where how has the management been performing over the last few years? How long management has been around, and have they went through multiple crises? And how has this CEO, the person that run the companies, has been doing over time in a sense, right? I think that is one of the secret to long-term investing. Cool. Okay, then number two, object number two here is surprise, right? So what I think he is trying to tell us that we need to embrace this word called uncertainty, right? In the world of investing, there is no such thing as sure bet. Even in his own writing, right, he actually said that he made multiple mistakes throughout his whole entire journey, and he learned and experienced that themselves and then overcome it over time, so that he will understand in the near future or in future, right, how can he choose better businesses, right? If you remember 2020, during COVID strike, he actually sold off all the airlines industry, and he actually suffered losses because of that. So it means, right, Warren himself is not just someone that can admit his own mistakes, okay? He is also able, right, to actually make difficult decisions to cut losses, and then decided what to do with the capital that is at hand. So when he liquidated the airline shares that he owns, right, he actually cost him a huge sum of money, right? But he moved on. Right? So many investors today, what I feel, and in my conversation with them, is always they have losses in their portfolio, but they refuse to really move on. But the issue with this is you lose opportunity cost, my friends, right? So if you are someone that having some losses in your portfolio, I will wish that to have a conversation with you or potentially help you in this journey also, right? Okay, probably future videos I will talk about how you can overcome some of the losses and how you can deal with them. Okay, so going back to point number three over here, right? So he actually mentioned about the $144 billion of cash position that he's holding, right? But he actually said this, right? Most of the time, Okay, for his company, he would actually prefer 80% of the net worth in equity. Okay, there is a reason for him, because Warren's company is actually a very capital intense organization. Okay, about a fifth or a quarter of the business is actually in infrastructure like railway and electrical power, or what we call by utility companies. These two companies, which is over here, BNCF and BHE, they are very capital intense, and because of this, right, they actually pledge, in a sense, in Berkshire's sort of like a code of conduct, right, or the rule of investing, more than 30 billion for these two companies. Why? Because they do not want to be at the mercy of banks or any financing company when these two companies actually need capital and they cannot find it. So I think that's being prudent. But he also said, okay, his most favorable status throughout the period will be 100% equity, right? So many of times when I look at Warren, right, it goes against the grain of financial education. What do I mean by that? Means as you get older, you might think that you want more stable income, you might want bonds. But the thing here is, Warren suggests 80 or even 100. Okay, so I just want you to understand, risk is not so much about your age. Risk is about, do you know what you are doing? If you're not knowing what you are doing, definitely reducing equity makes sense for you. So my suggestion for you is get to understand how to invest your money so that you are not suffering in the long run, in a way. Because according to him, those period that he is cash heavy position, right, he actually said they are never pleasant, right? Over there you can see, and they are always never permanent, right? They don't like the idea of it, right? But they will not buy for the sake of buying. Okay, there goes point number 4 over here. There are a few ways that they intend to do to really focus in adding value to shareholder today. Okay, which is actually increasing the long-term earning of the companies that they are holding internally, right, and reinvest to these companies again. And of course, their second option is to actually to buy non-controlling part interest companies. Okay, and thirdly is they know that the long-term interest rate in the world are likely to be low, which in turn push all the productive investment upwards in a sense. So in short, what I'm trying to say that because interest rate is low, there is no longer needed, right, to hold cash today, right? And in terms of cash earning paying instruments, you don't really get much in terms of deposit. And again, it's because interest rate is going to stay low, financing cost is likely to stay low also. So because of these two combination, cash seems to be more readily available. Therefore, deploying those cash into better assets is an option for them, right? But they also say that they are not in the hurry to look for acquisition, because they seem to believe so that today, for them, internal opportunity delivers far better performance than acquisition. So what it means for me is very simple. Today, when it comes to investing for you, are you holding companies that over the long term, right, when there seems to be opportunity for you to take? Means like, for example, in crisis, all the company in the world will actually go down in price. Will you be willing to take on more position of those companies that you own? If the answer is yes, good for you. You have done due diligence enough to look for companies that are solid companies over the long run, like 10, 20, 30, or 40, or 50 years and beyond, right? Like what Warren Buffett said, right? Every time he buy a company, right, he asks himself questions like, will I be willing to hold these companies over the long term? And when the word long term is being said, right, it's the word called forever, right? Because when your time horizon is longer, you tend to do due diligence better also, because you want to make sure that these are the best decisions that you make for yourself, right? So please understand this rule, because if you are not holding companies that you are willing to hold over the long run, that means that you are not deploying capital the preferred way, right? So for me, it's very simple. For all the companies that I hold for myself, even today, okay, based on Warren Buffett's rule, if the stock market is not open, right, there's no price, public price of the company share, will you be willing to hold them? This is how sure Warren Buffett is when he is holding all these businesses. Means he know in terms of his holdings, not just the public price, but in private pricing, quarterly private value, he is still willing to hold this company, right? So again, likewise for me, I believe in the same principle. The companies that I'm holding today, even when they drop 50%, I'm still willing to deploy and buy into all this company that I truly believe in over the long term. And when I say long term, the word is the F word, not the four-letter word, okay? The forever word. Okay, then one more point, and I feel that this is very important. So this is point number 5, right? Again, in the beginning, they said what? 2 things about them: long-term advantage of the businesses and a great CEO. So this is a story about 2 gentlemen and 2 companies, right? Where they are wonderful men and wonderful business, right? So there's this person called Paul Andrews that passed last year, according to him. And he wanted to sell off his company's position because he owns and built that company over the last 20 to 30 years, right? But because he realized that the options to sell to individuals are people who are willing to stay long term, that's where they got acquainted to Warren Buffett, and eventually he sold his business to Warren, which is Berkshire Hathaway, and the company has grown leap and bound since then. So again, is when it comes to business, right, what I want to say is that your value is more important than the P&L that you are going to generate over the long term. So this is something that I feel that if you are building a business today, if you are looking for business today, check the value, check the conduct, the code of conduct of the company that you are holding today, the individuals. Are they going in for the short term? Are they going in for the long term? That is why for me, normally I try to avoid companies like IPOs and SPAC, especially during the last few years that SPAC has been very prominent. Why not these companies? Is because IPOs are potentially making the founders rich in a sense, because they might sell off the company and not hold for the long term. They might not do what is right for the company, etc., etc., etc. But SPAC is even worse. Why? SPAC is like the shortcut for IPOs for companies to be listed in a company, to be listed in a stock market. So because of the intent of the way this instrument is created, of course it is financial innovation, nothing wrong with that. But to me, I just do not like the way how money is being handled. It's like a shortcut to riches in a sense. And many of the SPAC owners, right, or the sponsors, we call them, they are basically people like venture capitalists, private equity, etc., etc., right? How they name themselves. And many of time, what they want is just a big paycheck, okay, for themselves, not so much for us as investors. So I'm warning you, okay, avoid IPOs and SPACs by itself. And you can even check back, ever since IPO has been launched and SPACs has been launched, right? How many companies have lasted over the next 5 to 10 years, right? The statistics doesn't lie, the facts doesn't lie, okay? So please do not invest in hypes, but invest in facts and figures, okay? So if you watch until this moment, I really appreciate you, and please support my journey, our journey to build this community. Do like and subscribe and turn on the notification bell for future videos. So see you again. Bye bye.